Welcome, Pat. Happy
Hey,
Friday
buddy.
once
How you doing?
again. It's Friday. Holy cow. Time to
Yeah,
send.
where do the weeks go? I swear to God, it seems like you and I are getting together every other day.
Yeah. Well, we did have fun. Was it Wednesday? We went down to Oso Brewery and met a few YouTube subscribers, and that's fun. We're
Yeah,
gonna have a few more of those, and as the
that was
year
kind
goes on, we'll have one in Tempe. Maybe go to Phoenix. Now, what the
of,
hell? Maybe we'll go to Flagstaff.
well, we got millions of viewers. You never know. We might be in China someday. China, Florida,
Yeah,
wherever.
yeah. Well, speaking of millions, I'm looking at the number up there, and so I'm going to have to put this on. There we go. Now we have millions of viewers. So,
Yeah,
so
whether it's a million, 2 million, whatever. All
yeah.
righty, but
Yeah. So,
so,
boy, I'm gonna start with you. Here we got Tyler Carlton dance. Always good. That's the way to start. You should see my oldest son, Tyler. He can do that. He can. You would swear to God he's Carlton. He was out with his girlfriend once, and they were at this big function, and they were having these contests, and they said, "Okay, this one is you have to do your best Carlton." And his girlfriend looked at him and says, "They don't know anything about you, do they, Johnny?" He got up and just nailed it. I don't know
crushed it.
what you crushed it. Yes, no,
Crushed it.
we
Yeah.
banned we banned that word. So Pat,
Yeah.
so a lot of confusion over the central bank and their ability to alter interest rates, and they've obviously put a bullet in the housing industry. So everybody's waiting this week and saying, are they going to go up 0.50 or 0.75? And so the market had already built in, the half point. And then lo and behold, they come in, and not only do they raise it a half point, but that Fed Chairman Powell was not very optimistic. He was saying that, and he's blaming a lot of it on labor, saying that, there's still a big labor shortage, and inflation looks like it's, running hotter and longer than we anticipated. And some of our steps that we've taken are not working yet. He completely ignored housing. He just made one small mention of it. But then lo and behold, what happened to interest rates? They went down.
Yeah.
So I want to share your chart and tell us what happened there. I mean, it's so, and more importantly, why did it go down?
Well, I mean, it's basically all inflation. Rates have stabilized. Rates are kind of consolidating right now. You see this period where we saw obviously this treacherous peak here. These are the rates now. I flipped the chart around.
Okay.
The 10 years at 3.49. The 5.5 coupon's down 5 today. But we saw this treacherous peak here. But this after this run up which was just that's just a painful run up from October 4th, October 2nd to October 24th. So August, September, you got 3 months of just I mean, it was just death by 1,000 cuts, and now it's they're shifting from the inflation fears to recession fears now. So
Yeah,
I've
been reading about that.
I think I'm seeing a lot of articles saying how the Fed, a lot of these billion-dollar institutional money managers are just kind of throwing water on the Fed, saying these guys. Reading between the tea leaves, it's like these guys don't know what the heck they're doing. Some days it's like they're running these rates up, and now they're talking about labor. Seems to me with the disconnect with COVID and the employment that they're looking at the employment numbers, but once again, we talked about this a couple of weeks ago. You got what? There was one guy out there saying there's, Michael Lowe was saying there's like 10 million job openings, but there's 5 million people out there that are not really working. So, I mean, if it was a better indicator, I would say the employment numbers definitely are a good indicator. But what the feds are trying to do now is flip from the employer to the employee, because the employees got the power now with the wages going up, and they're trying to flip that equation from the employee to the employer. So the employers got more power, but that's going to be a long time to bring that out of the system. And I'm hearing talk now too about them saying the Federal Reserve saying with the target of 2%. A lot of institutional money managers are saying that's hogwash. to have a target of 2%, it's going to take a long and hard road to get there. And maybe they should change it to maybe 3%, you know?
Yeah,
Uh,
yeah, and I was reading too, Pat, that said that basically the market is telling the Fed that they're all wet, that they're wrong, and the
yeah,
market
yeah,
has been right more times than the central bank has been. So they're pushing back, and
yep,
they're not willing. The market is not willing to say we're going to watch you keep throwing these rates up until we get to 2%, because now we're worried about a recession. And so, like you just said, that's what the numbers are reflecting.
yeah.
So
I mean,
it's going
because
to
we
be a
went through
weird year.
it is. You said it's going to be or has been.
Yeah, it's going to be, and it has
Oh yeah,
been.
it's going to be definitely a weird. I mean, it's been a weird year this year, but I mean, obviously we saw the shift. I mean, this whole 3 quarters of a year that we were worried about inflation, inflation, inflation. Now you're starting to see the market kind of roll over and say, okay, the recession, that this trends are rolling over here. And, like I said, we're shifting from inflationary fears to recessionary fears. But the rates, I mean, go back to that chart. Um, we're kind of consolidate. I mean, if we shifted it, we've been kind of consolidating here in this channel. There's these channels that the rates will consolidate in, and they have before. I mean, you saw here kind of consolidate into this channel, and then we saw rates go down a little bit further. And if you pull it out further, I mean, 2 years, this is a 2 year run up. I mean, we might see something settle in this channel here, going forward. So,
Well,
the problem is now the next couple of weeks, you're going to see volatile days because the traders are, you're going to see volatile days where traders are clearing out their positions. Kind of today was kind of the start of the holiday mode this Friday because, next week is really what's going on next week, before Christmas. And then you got New Year's. So the next 2 weeks, it's going to be quiet, but there is news that comes out. You're probably going to see more volatile days, because there's less traders out there shifting their position around.
well, it's hard to get excited about inflation coming in at 7.1 instead of 7.2 when you look at a chart like over here, see that the inflation, is has spiked up like it has, and and you can see why that happened, because if you look here, this is March 16th. So this is February 17th, 2020. This is when all those checks went out.
Mm-hmm.
This is when, in Ben Bernanke's scenario, helicopter money, we can lower rates so much, but sooner or later we may just have to hand people checks. All this money went out,
Mm-hmm.
and this is M2. This is money supply. Now, one of the things that I read yesterday too said, you can't expect inflation to really take a really hard turn until this thing starts going the other way.
Mm-hmm.
And it's barely going the other way. So if I think the worst thing that I hope we don't see anytime soon is anybody in Congress saying we need more stimulus, because then we've just bought inflation for the next 10 years. So in
Mm-hmm.
my humble opinion. Now, what's going on in our market here is interesting. This is from Tom Ruff from our association. He's one of the analysts, and he said, as of December 1st, in terms of median sales, we're now reporting negative year-over-year price growth. Couple negative price growth with a 45% year-over-year decline in sales volume, at least in terms for our housing market. Your peers were already in a recession. The question now becomes, when will the Federal Open Market Committee conclude? In a recent article published in the MR Report, Martin Green, principal with the mortgage law firm Polunsky Beidel Green, said, interestingly, mortgage market participants are still optimistic that interest rates will fall in 2023. The question is whether the market is still being overly optimistic, or whether the market has a better reading on inflation and possible effect of the recession than the Federal Reserve does. As far as our local housing market in the short term, I see more clouds on the horizon. I see a ray of sunshine. So basically, they're saying that those in the know in the mortgage business are saying that they know more about where this inflation is headed than the the central banks. And that's what I was reading, beyond that little discussion there. And here's a graph, Pat, showing some of our numbers. Change in monthly at average price per square foot. Your alien's going off again. Is that
Yeah,
your?
what the hell is that? I mean, I
Yeah,
shut my
I don't
email
know.
off.
Yeah, I don't
Anyways.
know. It's your neighbor. So you look at this though, over 3 million, up 3.3%, 2 to 3 million, up 14, 1.5 to 2 million, up 8.8 monthly average sales price. But then when you get down into 400,000 to 500,000, down 1.5%. Where they're interesting, where they're declining the highest, which is surprising, is 275 to 300, down 4.6%, and 300 to 350, down 3.5, because that's still a relatively competitive price point. You get the lowest one here, 2 to 225, and you're up 5.9. So that kind of surprised me. I thought I'd see more declines in the 500 to 800,000 range.
Oh, no doubt.
So, but here's our monthly average sales price overall here. So we kind of had a little jiggy up and then a little down there and then kind of a little slight uptick. So it's clearly going down. If we were to draw just a normal trend line, we'd end up like here. So maybe prices will converge right about here, right? So could be if we were just to take a look at it analytically. Active listings are the story of the day. The reason that some of the CMIs came out, Cromford Market Index, a little more positive this month is simply because of the lack of inventory listings, new listings coming on. You can see it's just up a tick, but still way down. Under contract is really kind of trading in a tight range here. Not really growing, not really shrinking. Expired listings are not, they've come up quite a bit since April. They took a big turn starting in June. That's when the rates go up. Murray goes, well, we're not going to sell the house, so let's just let the contract expire. And that continues on a monthly basis. Not a whole lot of canceled listings. There's a few, when you look down there, we had 557 and now we're at 2335. Well, I suppose that's pretty significant. People getting out, trending down. The interesting thing is the list prices per square foot. There's the sold price, but the listing price per square foot remains everybody in a holding pattern, kind of probably looking and saying, well, let's see what happens after the first of the year. In the meantime, I'm leaving my prices where they are. The contribution for closing costs is up 48%. But the people that are doing well are home builders. And you sent me an interesting article here. Intensified housing market correction has home builders offering sweetheart deals to Wall Street. What's that all about?
I mean, the article goes on to say that, I'll just kind of read it. Some of it talks about home builders have a housing downturn playbook that's effective time and again. They said they're offering, mortgage rate buy downs. This is fast forward to 2022. Home builders have clearly returned to their housing downturn playbook, and there's only one wrinkle. It's institutional investors. It said institutional investors like Blackstone saw an opportunity to buy more directly from distressed builders. And then they went on to say, it was interesting dynamic talking about how it says these institutional investors don't want just markdowns in the 10% ballpark. They're hoping for 20 to 30% price cuts. They talked about the mortgage decline, the mortgage rate decline. It says in an article, it says that, it talks about the decline in rates means the housing bottom for housing demand might be in the rearview mirror. That's why Wolf says some institutional investors might be ready to pull the trigger. What we're hearing now is that some investors, because rates are down, they're afraid that primary buyers are going to be coming back into the market. So that some of the institutional buyers are trying to rush in now because they're afraid that there'll be a pop in demand from primary buyers. They're going to lose that opportunity. So it kind of goes along with
that's it. So they're saying that they want to scoop them up in these builders right now, but they're worried that they're going to have more competition from mom and pop kettle out there trying to go in and get a house.
Yeah. And that's why I've been kind of
Interesting.
saying that the last month or two. Remember, I've been saying that if we see rates dip into we're seeing rates in the high fives, low sixes. People, they saw a 7.25. From a behavioral economist standpoint, they're like, oh, people are saying, okay, we want to buy. If they can settle into maybe the mid fives, let's go back out there and try to, because it's going to be I didn't run the numbers, but you figure, what the heck, just run this rate sheet, say it's 7.25 on a 475,000 purchase. Say 7.25 principal and interest was 3,078. But if you can get into the say the mid fives, let's say 5.5, that's 2,562. Yeah, that's about let's just call it a $500 a month difference in your monthly payment. So that's going to bring a lot of people.
If it gets down to mid fives, if people start popping back in, I think we already saw that. In July, and that's what boosted our August sales numbers. Running an altitude here says we're already seeing 10 to 20% cuts on new builds. They discourage Wall Street investors from buying whole communities, though. Yeah, that's really a debatable subject, and it's going to, if they keep it up, it's going to get a lot of attention. But how do you really, take a free market, clamp down on that? I don't know. I don't have the answers for that.
That's pretty simple. Just, the builders, they got to give, first time home buyers a first right of refusal, or, give people,
that would be nice.
Give families a chance to buy a house. Instead of going in and letting Blackstone buy a couple hundred homes. I think that's kind of crap, if you ask me. I just
we're at 2020. We are at December 2021 pricing levels right now. So in other words, all the gains for 2022 are gone. Are we going to get down to 2019 where a lot of people are hoping? I don't see it. Now we have a major recession, problems in the credit market. I'm certainly going to keep my eyes open, but that's a pretty wild dip to get down to 2019 price levels. That's way down. I'll show you on the chart here. Let me erase this for a moment. So we're going to have to go from here to, I didn't know that would move the whole chart. Let's see. There we go. We're going to have to go to 2019. We're going to have to go right down to here.
Yeah. Wow.
So that's taking the natural trend of 4 to 5% raises and completely blowing it off. Now, there's certainly been economic events that have shocked us in the past, and I won't completely rule that out. I'm just saying that for me, it looks highly
It almost
unlikely.
looks like a crash at the doomsdayers are saying that would happen. That if it gets to those levels,
it would be a glorious day for some of those YouTubers. So I took a couple to task last night. Because the guy had this thumbnail that said 50% of homes are underwater. And then, he quotes an article from the LA Times, and you read it, and it's not saying that at all, but that's what the title said. And it just said that 8% of homeowners that bought in 2022 are underwater. Well, that's a far cry from 50% of everybody. I thought, I hope you get your clicks and you get your money. But the thing is that there's a lot of misinformation out there when it comes to opinions. And so I think if you're going to have an opinion, which everybody does, including me, then, share some data with it and look at it and kind of think about it and analyze it. And consumer confidence is down. Yeah, it's, the thing is that and Pat, you and I have talked about this before, when you're not really going to know when it's time to jump back in. If somebody says, I want to get in when prices are down 30%, I'm saying, I bet you don't, because the news is going to be so bleak. You don't want to get in. No, probably the best time to get in is when prices just start going back up. That's when you want to get in. Then you're going to go, oh no, they're going back up. I'm going to be priced out again. So, you just have to figure out what your comfort level is. Now, I was talking to an agent yesterday. I'm going to be showing a house tomorrow, and we got to talking about sellers in general. And she said, unfortunately, despite everything that I've showed them, they're not really in tune as to what's going on in the market for sellers right now. In other words, that was a kind way of saying they're probably going to stick to their price for a while.
Yeah. Yeah.
But I can see that because I go, well, my buddy Bob down the street sold his 4 months ago, and 30 people came and looked at it, and there was a bidding war, and I'm priced below him. I should be okay. And they're not up on the data. And
No,
I know I've had clients where I've showed them the numbers, and when you're dug in, you're dug in.
Yeah. I mean, the average guy, the average Joe and Barbara Smith, they're doing their job. They're not, unless they're one of the millions of viewers that are watching us every week. I mean, they really, they're not attuned to what is really going on. Like you said, they're kind of stuck in that probably March, April timeframe. It's
we're up to 11 million right now.
11 million. Oh, good.
11 million. So keep you up to speed there.
But I think the average guy it's gonna be one of those markets. Like you said, that article I thought was interesting, the institutional, the home buyer with the institutions, because this time frame it's quiet. People are buying and selling are obviously very serious. I've been steady busy. I've got some buyers, we got some people working on stuff like that. So, I mean, there's people that are not totally, throwing out the baby with the bathwater, not looking for homes or want to buy. There's serious buyers out there. And I think they're okay,
no doubt.
I'm just going to, it is what it is. A couple of people like, I don't want my payment to be that high, but hopefully rates will come down here in the next 12 months, 18 months. So we can, refinance a little bit cheaper. So
there's another stat here that came out, Pat. I want to show you median closing prices versus median close price adjustments after concession. So in other words, you sold your house, but you gave them $15,000 in concession. So they collect that data, not from builders, but from resales. And they're showing that blue says median sales price, and the darker line here says the sales price minus the concessions, changed it by $11,000. So even though it's going down, that again sticks to what we've been seeing when I say that they're leaving the asking price here, but they're willing to give you more on the back end. And this is actually showing yet indeed that's what's happening, because closing cost contributions are up by 40. They're 48% of the transactions. They're giving you something, and closing cost concessions are rate buy downs. As a seller of rental property, it's hard to let go. The rent is still high and rate super low. You probably won't let it go. There's no reason. Renters, I was talking to my buddy yesterday, and he goes, I'm sitting at 3%. Why would I sell?
Yeah. I mean,
and
it just goes back. I start, like I said, I'll pat myself in the back. I started talking about this last year, or earlier this year. It's like, you got this equity lockdown, or equity and rate lockdown that, now people are all talking about it. And it was very clearly evident that, the average Joe is at 3%. It's not going to go anywhere. So it's just, you could talk to 1,000 people, and I guarantee 998 of them are going to be like, no, I'm not moving anywhere. Like you said, Running Altitude said, people are equity rich. Yeah, they bought a stock. Like I said, they bought a stock at 10 and went to 25, and it's still sitting at 20. So they're like, okay, I'm still up on the stock. So,
Miriam, a lot of people were equity rich in 2008 for all the wrong reasons.
All the wrong, total wrong reasons. Yeah.
So, I mean, I would ask the question, how many loans do you think are going to reset next year? How many of them are going to go from interest only to 7%?
Yeah.
None. I mean, especially if 64% of the homeowners right now are at sub 4% mortgages. And I think, and all eyes are on the first of the year, but we're sitting at 18,070 active listings today, which is, considerably higher than last year, but quite a bit lower than November. And so I don't know, are we going to see a pop in January? It's going to be hard. I don't see anything that says, okay, here we go, boom, flood of listings, unless you just get that that seasonal bump that says, well, I was going to wait till January anyway. And did you guys see the jobs report revision came out yesterday? Actually, it was only 10,000 jobs added instead of 1.1 million. I missed that, really.
No, that's what I saw. I saw that last week. Actually, they were saying that the numbers is really, it was really way off. You know, so there was some there. If you do the analysis behind the analysis, that it was, the numbers were off. And that's, I know these jobs reports, all they are surveys. It's not like, it's not an exact number. It's really household.
Well, I understand only 49% of the businesses responded to the survey.
Yeah. So I I just have a hard time with some of these numbers that they come out and they just get so locked in on them and glued in on them. It's like, I don't know. I mean, like I said, I just try to take a temperature of talking to a lot of people and seeing what's out there. And you can kind of get, like I said, it's almost behavioral economics and see how people behave. And right now it's real. People are just quiet sitting there. And like I said, that institutional buying, I think there's people out, if people are serious, it's not a bad time. Things are going to soften up, but like you said before, get your ducks in a row.
Yeah, I think if you're a home buyer or somebody that's thinking about home buying, or even if you're not right now, as people are looking at these inflation numbers and the central bank doing what they're doing, there's one thing that's abundantly clear, and that is pay off your credit cards.
Yeah.
Because they, you have a balance on there. They can raise your rate next month. Now, if you have a personal loan, they're not going to raise your rate. So if you can convert your credit card balances to a personal loan and get a fixed rate, then you're better off. But be very careful and start watching your credit card interest rates, because I've seen them go from 23 to 28%, which seems just obnoxiously high. And so, and it's going to jump up and surprise few people. So hopefully you're not loading up your credit cards for the holiday season, but that would be my watch out, coming into this inflationary environment. So while the central bank is raising their benchmark rate, and it really hasn't made mortgage rates go down this month, it's definitely having an impact on what banks charge you with credit cards. So I said I'd watch that carefully. And then, but what can make this optimistic feeling that rates may go down to the 5.5% in January? What can derail that, Pat?
That's a good question. I wish you would have prepped me up on that question.
Well, then the show wouldn't be any fun. So you know how you're the one that has a little train going through there. I have the same thing. I just don't tell anybody. So
yeah, the train stopped at the station here this morning. There's a big offload on passengers going to the relative's house, so it hasn't left the station yet. But I mean, it's I think the Fed. The biggest thing is probably the biggest question is probably going to be going in the future is how long are the Feds going to keep, their pedal to the metal as far as keep the rates, at this. Now they made their move. Now they're saying they can go to 5. I think their terminal rate's 5.1, or now they're bumping up to 5.5.
Yeah, I don't think they're going to stick to it until they get to 2, because if they get to 2, we don't even have an economy, I think. But if we get a surprising inflation report, then 5.5 is gone.
Yeah. But what Barry's been saying is that the inflationary numbers they're coming out we're probably going to see a peak in January if we see an inflationary number. But he said what was that one? The rent away from home was going to be coming down. That was an inside number that a lot of these people were not picking up on. And he said that that's going to be coming down. So that's going to have a positive effect on the inflationary numbers. Like I said, he's expecting rates to come back down here middle of next year. So
rent away from home is hotels, motels,
that's right.
Airbnbs.
Yeah.
And Airbnb revenues are way down.
Yeah.
Way down. You look at Scottsdale, and the average Airbnb nightly cost is, I think it was like from $290 to $210. My brother has an Airbnb at his place. He said he hasn't had a booking in 2.5 months.
Really?
Yeah, yeah, and, people were going out like crazy because "Yay, we're not locked in home, we can go out,"
Yeah.
and now it's just like so everybody's expecting that to be the norm, but people don't normally travel at that much velocity like they were in, early 2022 and 2021. 2021 was the year you got out of house jail, so everybody's heading out to the Airbnbs and instead of going to a hotel, and,
Yep.
so that's just probably just getting back to a normal level. So eventually, some of these guys are going to have to put those on the market. I don't think you're going to see this big wholesale dump of short-term rentals. I know there's a lot of chatter here. Once the Super Bowl is over, they're going to get rid of them. And I say, well, no, I hang on to them because you got spring training coming in March. So,
Hmm.
you'll still do well, but we'll see what happens. Matt says the pivot already occurred. They slowed the rate of increase. It's like someone bluffing at the poker table and putting $50 in the pot on the river after you just put $500 in the pot. So um, I'm not a good enough poker player to connect
Yeah.
that one, but if you want to win at poker, play me.
Yeah.
So
But yeah, the pivot, I mean,
yeah,
they say the pivot has,
they
I
are
mean,
backing off.
they are backing off. I mean, but once again, I just go back to my theory that, now it was an egotistical, now they're going to say, okay, we're going to get tough on the market now and stay tough for a while. That's the thing. So, but they've never been, they haven't really impressed me in terms of what they've been doing. And, I was listening to this one gentleman, they're just fast and determined to have a recession. And there's one institutional money manager I was watching on Fox Business News. He was like, why do they have to push us into a recession? Why we shouldn't even be there. Is that
Yeah. I saw the same analysis, and he says, why? He goes, just
what?
stay out of it, let the market adjust,
Yeah.
and
Yeah.
we don't have to have a recession to tamp down on inflation,
Yeah, exactly. You know,
but we have
uh,
to wring out that excess money that's out there. So
yeah, they have
um,
to. They're stuck. They're stuck because they know they've done wrong. It's like feeding. You just fed your kid candy for the last 3 years, and you're like, shit, he's gained 40 pounds, and now what do I do? Now you're gonna turn him from candy to vegetables. It's like,
yeah,
no, it's like
yeah,
no,
yeah.
so
Oh, good morning. You're a vegan.
yeah,
What's that mean, mommy?
yeah. So
So
anyway,
well, cool. Well, look, next week we're coming up on Christmas. We probably I'll kind of wait till we get there. We might not do one Friday because I know everybody's going to either be traveling and
drinking
or
eggnog and whiskey and brandy and
well, you
so
and I'll be drunk. I mean, that's a
yeah,
given.
I'll be hammered, but
So,
yeah,
that'd just be a bad show.
yeah. My face will be even redder.
Yeah, I'll be under the table. I got the all you'll
That
see
would be
is do you like my Merry Christmas behind me here? That I
yeah, that's
I
good.
kind of upped
I
my
just thought about
technical game.
we should do a drunk show.
Oh no, no, I worked at a small radio station out in Forks, Washington once, and the and the manager wanted me to come in and record a bunch of commercials, and I was sitting at my place with my buddy, and we're down in a bunch of drinks, and I lived right across the alley, and there's a cab right there. I couldn't get through them. I'm reading this content. I couldn't finish. So I think I strung together probably about 20 commercials, and I think he used one. So I was 22 and I learned my lesson then. So no, I'm not going to do a drunk
All
show.
right.
That's,
Oh well, just a thought.
there's Friday Pat. Yeah, that's
Yeah.
right. Quick question. How do you compare Sun Lakes Chandler compared to Sun City West? Well, um, gosh, couple different things. One, it's
There's not as
certainly
many people that die in Sun Lakes and then Sun City. Sun City's like the one step away from the funeral home. It seems like
yeah.
nothing happens. That's my
That's I can't take you anywhere. They well, right now in terms of real estate, they don't have as much of inventory as growth as what we're seeing in Sun City and Sun City West. So for sellers, Sun Lakes has got a little bit of an advantage compared to those other two areas. Their price point, their average price point is higher. Sun City West is, or Sun City, most of those homes are built in the 70s. And they have a lot more patio homes and connected condos than you do down in Sun Lake. Sun Lakes is a smaller footprint. The HOAs are about the same. I think Sun City and Sun City West has a higher capital improvement fee than Sun Lakes, but both of them are somewhere between 4,000 and 5,500, which has to be paid by the buyer when you're coming in. So that kind of stings you. But that keeps them from raising their HOAs. So rather than having special assessments and raising your HOA, they just count on the buyers to come in and contribute to the capital improvement fee. So I hope that Stephanie, I hope that answers your question. That's what I know about those two markets. And
Sun Lakes is a nice little pocket. I like Sun Lakes, you know?
Yeah, I do too. I got good friends down there. I like going down. We found them a really nice house down there about, I want to say 3-4 years ago, or time flies with me. It may have been longer than that, but they got a cool little place, and the restaurants down there are really good. They have some good happy hours, some good wine, so fun place to be. So, well, Pat, you have a super weekend. I'm going to be out showing some homes tomorrow, and I don't know what I'm doing on Sunday. Maybe just taking it easy. So,
cool. All right. Well, have a good one. See you
all
later,
right,
everybody.
take care. See you, everybody.